Hey traders, how's it going? Nick from Vant Trading here, coming at you with another technical analysis indicator lesson plan. Today I'm going to be talking about the advanced decline line, and I'm going to be differentiating that between just the advanced decline difference, which is a chart you can also pull up. What is this? Why do some traders look at it? How can you use it to measure a market's real move? And we'll just give you a little bit of technical information here so that you can feel whether this is a right indicator for you or not. Reminder, if this video is at all helpful, please be sure to drop a like and subscribe to our YouTube. If you have any questions, comments, or concerns, drop them in the comment section below. Now, looking at the advanced decline line here on the SPY, this is the line I have down on the bottom. Whether your chart overlays that or not, I don't know. It really depends on your trading platform. What is this technical indicator? Well, what it is doing is it is literally plotting the number of advancing stocks that are ticking up, versus the stocks that are declining on a daily basis. And it's doing that in a cumulative manner, which means that every day it's adding that net number onto the previous days. So this isn't a wipe the slate clean every day type of scenario. This is a, over the time frame that you're looking at, what is the trend of this advancers versus decliners? So if there were more decliners in a day than advancers, you can see it's red on here, and that, it's actually starting to slope downward, which means it's taking away from the cumulative. And so a lot of traders use this to try to gauge market sentiment. Are there a lot of different stocks and securities following the market higher, or is this just a kind of a shallow rise where not many stocks and securities are participating? What are some issues with the advanced decline line? I want to address that first because there are issues. First of all, it's going to start calculating based on the time frame you're looking at. So for example, right now I'm looking at a 1 day, 1 year period, which means it started calculating right here on the day 1 year ago. And we never technically crossed down below zero because, we kind of started on a little bit of an up move, and those decliners never dragged us down. So that's going to actually weigh in. For example, beginning of 2020, we had the COVID pandemic, the stock market crashed. What if I go to a 2-year scenario here and actually include that? We still technically never crossed zero because it started calculating all the way back here and had all of this cumulative number built up. So, technically you could say, well, yeah, it doesn't need to cross zero. The real reason you want to be looking at this is looking at the sharpness of the slope and the slope itself. If the market is moving higher but the slope isn't moving and we're stagnant, that typically will reflect that the market is moving higher based on only a select few securities and that the entire market isn't participating. That's one way that you can look at this thing. However, if I say started in February, I go in here and have this custom start calculating on February of 2020, you'll see a very different number here. Look, we actually dip into negative territory because it started calculating, and didn't have much of a cumulative number to knock off of. So that's just one of kind of the issues here. Another issue is that you really can't put too much weight on this because, let's be honest, the market, the SPY, the Qs, a lot of these are actually weighted by different companies and their market cap. So the market can go higher if only the larger companies drag this market higher. We're kind of seeing that, and we saw that over the summer where big boys like Apple, Amazon, Microsoft, they were more or less dragging the market forward while a lot of the value plays and reopening plays were just not moving. So that actually happens a lot. Also, this is typically based off of the NYSE, but if I go in here, yes, I can put the NASDAQ on here. But keep in mind, some of these exchanges like the NASDAQ typically have a lot of smaller stocks that delist or a little more speculative, kind of low floaty, and don't really do much. So it is going to be weighed a little differently or look a little different with the NASDAQ. It's a little flatter because typically we are dragged, we're dragged higher by the big companies a lot more often on that. So typically traders will be looking at the NYSE advanced decline line versus the NASDAQ. That's just kind of one of the scenarios. Now, I want to draw a comparison here to a chart that you might have seen Mike pull up because he likes to look at the advanced issues versus declining issues difference. This is just the flat difference. It's constantly measuring, all right now at this moment, how many more stocks are advancing versus declining. It's not cumulative. And he uses this as a forward-looking mechanism in terms of trying to see, okay, are we really pumping higher and is the market following, or vice versa, are there divergences? So they are different indicators. Keep that in mind. They work hand in hand in it to an extent, but there are differences and there are limitations. So keep that in mind. But this is generally all it is. It's just simply a cumulative addition onto how are there more advances versus decliners, and so you can't just take the number itself. 57,000, that doesn't mean anything. It doesn't mean anything in the grand scheme of things. What most traders will be looking at is the slope. They'll be looking at divergences between price action and the advanced decline line, and it's just their overall gauge on what really is the market sentiment. Are people just buying everything? Are we rocking and rolling here? Or are we kind of sleepily walking forward while only the big boys drag us higher? It's not something to necessarily just base your decision off of, but it's something that a lot of traders like to look at, and it has a little bit of respect and weight in the market in some circles. So hopefully this was helpful and informative. There's not really much else you can look at here. It's just a simple addition and subtraction formula where they're taking all the stocks ticking up versus the stocks ticking down. This was Nick from Vant Trading. I hope that this was helpful and informative. I will see you next time, and as always, safe trading.